Tom Lee, co-founder of Fundstrat Global Advisors. This is one of Wall Street's most consistent bulls. And in this CNBC interview, he explains something that is catching a lot of attention right now. He says that most major funds have been positioned bearishly, sitting on too much cash, staying defensive, and that has led to widespread underperformance. Now, as the market pushes higher, these same funds, they could be forced to chase returns just to catch up. That kind of dynamic can fuel powerful year-end rallies and is a setup that can extend beyond equities into risk assets like crypto, especially XRP, which tends to move fast when momentum shifts back to risk. Now, before we play this clip, gotta read to you the disclosure. This video is informational and entertainment purposes only. It's not financial advice, and it should not be taken as such. Let's roll the clip.
I wanted to give you some quantitative stats. If you take AAII, which I think is one of the best surveys of high net worth retail investors, it's averaged minus 11.7 this year, negative 11.7. There have only been 3 other times in that survey's 35-year history where the year-to-date average has been negative. All those times have actually been associated with bear markets. And so sentiment has averaged this year what's consistent with a bear market. So it is the most hated V-shaped rally. Now, there may be some people who say they're no longer bearish, but their P&L doesn't reflect that.
No, that may be fair, which leads us to the potential of a chase into year end when they realize that what's at stake for them if they're not engaged.
That's right. And we know 80% of fund managers are trailing their respective benchmark this year. It's the worst in almost 25 years.
Tom Lee really showing an interesting dynamic we're in right now. A lot of fund managers, they've underperformed the S&P 500, of course, Bitcoin, all sorts of other things that their investors could do with their money. And they're in a chase position now where they either have to look them in the eye and try to explain why they should hang around for another year or possibly lose a lot of money out of their funds. And this is a great time for crypto as ETFs, especially for altcoins, are going live here shortly. It's a high growth segment where people might, in a chase position, look to make up for some lost ground. So if Tom Lee is correct, this is going to be, a pretty bullish end to this year. We'll have to see it play out, but it seems like a pretty good setup there. Now, David Schwartz saying the following. This is good to keep in mind. He says you have to decide if you think you can tease out all the necessary factors to pick winners and losers. If so, well, just pick the winners. But if not, if you're not able to see into the future, we'll just bet on the whole sector. We know the crypto sector will grow faster than real estate and precious metals and most stock indexes. So sometimes just make it easy on yourself. Get your major cryptos, have some investments in some D-apps and some AI sector and stuff like that, and just let it go, and it should take care of itself. And he also goes into, in the 2000s, if you're going to pick between Google and Yahoo and Ask Jeeves and all these different search engines, some people are making the case that, hey, search wasn't a great business. And if you knew it was and you could see at least that far into the future, would you pick Google? I mean, Google tried to sell themselves for $5 million at one point and $50 million at another. They themselves didn't know they were going to win. So how could you, the investor? So just something to keep in mind. I think that's a grounded approach that David is saying here, that, sometimes what's important, but you might not know the specifics. So play it straight up the middle and just bet on the sector. Not bad advice. Now, David also says this. I think institutional adoption is needed to pave the way for the next wave of retail adoption. If DeFi is going to replace TradFi, it's going to have to do all the boring things that TradFi does. And institutional adoption seems to be the most likely way to make that possible. Now, what's interesting here is this. What he's saying makes sense, right? Who's going to build out these systems in the future? Probably the institutions. Is that the way it's working, at least to date? Well, no. Your Aves and your makers, they're the ones that are actually getting the most action, and that's where the institutions are going. So what he thinks is going to play out, that's not what we've seen to date, but I think he's right in that aspect that we will see this shift when institutions really jump in here and they have the regulations to do so and to build out compliantly. You're going to see this shift, and David's future that he sees happening will take place. It's just you have to note, as of now, that's not the way it's been. The private sector's built the winners, and the institutions are jumping into those spaces. That's just what we've seen to date. But I think, of course, regulatory issues have held back David's vision from taking effect. We'll see it. Before we continue, just make sure you subscribe to the channel for daily crypto updates. Really appreciate it. Now we see this Coinbase rises after revenues climb more than estimates. This is from Bloomberg, and it's pretty interesting here. Shares of Coinbase rose more than 8% after the company reported third-quarter revenues that surpassed Wall Street's estimates. So crypto still doing well. That was also an indicator to a continued bull run. Revenues grew 55% to 1.9 billion, beating the estimate of 1.8. Net income saw a yearly fivefold increase to 433 million, up 75.5 million in the same period last year. Now, what's driving this? This is what's interesting. Well, the biggest driver of this revenue is stablecoins. 354 million in revenue from its stake in USDC issuer Circle. So this is going to be a big driver of value in cryptocurrencies. And I think that you'll want to look at those blockchains that support effective and efficient stablecoin, issuances and transactions and things like that. That's where you're going to see a lot of growth. Also, derivatives, of course, was a big area of growth. 52 million. I mean, it's not as much as stablecoins, but it's there. It's significant. That's good to see. Now, there's a lot of people that are worried about Michael Saylor here. We see from Bloomberg, strategy and analysts sound the alarm on Saylor's Bitcoin premium. Michael Saylor's Bitcoin treasury company Strategy reported a 2.8 billion beat on third quarter net income. But there's at least 3 Wall Street analysts that have lowered their price targets for the companies. And the analysts here cite concerns over shrinking premium on the company's Bitcoin holdings. So, the premium has been much higher than the value of their holdings, but it keeps shrinking. How do you stay ahead of that? The premium is the multiple at which the company's stock trades compared to its underlying Bitcoin holdings, and this makes it a tough environment. Why are they getting a premium? Because they're using so much debt, and they're going to try to continue to do that. But if they don't get that premium from the market, well, it may be tougher to issue all these different financial products they have, like their preferred stocks and their bonds and all of this kind of stuff. And if they can't do that, if they can't raise cheap money, well, that's a problem. These analysts are saying that Bitcoin's price would need to hit over 150,000 by year end, a significant jump from where we are now, for Strategy to continue its momentum. So let's see that play out. A lot of analysts are worried about Strategy as we go forward. Now, the digital euro right now, we see from Bloomberg, digital euro could be curtailed until EU lawmakers go over this proposal here. So the lead EU union lawmaker on the digital euro has introduced a proposal that could significantly curtail or delay the launch of their fully online digital currency. They plan to actually launch that sucker, have it finalized by the end of 2026, and to go live by 2027. But here's the holdup. They're saying, what we should do is much like what we're seeing here in the U.S. We should sit back and see if the private sector, if they can come up with these solutions, kind of game that out for us, see if that meets our needs, and only if they cannot have a CBDC. Now, honestly, myself, that's what I would like to see. I would like to see stablecoins running on trustless rails, not these dystopian systems that are designed by the European Union or the U.S. government or anyone else like that. CBDCs are digital prisons, but we'll see this play out. This could delay things, that transition in the digital era, at least in Europe here. We also see Grayscale. Here comes altcoins. So they're seeing this transition. They're looking at ETF inflows to Ethereum. They're looking at the ETS pending for XRP, Solana, Cardano, and a whole swath of altcoins. And they think this may be the alt season we've all been waiting on. If that dynamic actually comes to the fold or not, we'll have to wait and see. But that's what Grayscale's seeing. This is the moment where altcoins start to kind of outperform here. Now here we have the head of trade for BlackRock. And he's saying one of the problems here is institutions are trying to figure out crypto. How do they look at this? Bitcoin and really by extension the broader crypto market. Is this a digital gold? Is this a hedge against other financial assets? Is this some sort of risk asset like a tech stock? Let's hear what he has to say. It's pretty interesting.
Trying to understand the risk and return drivers of this, because when you look at it fundamentally as a global scarce emerging monetary instrument that looks a lot like digital gold to many people, and that is detached from the risk factors that affect any one country or their economy, monetary, political, fiscal situation, etc. That looks like a diversifier and a hedge on a fundamental level. But then you see this noise in terms of short-term trading episodes where people talk about risk on. That's a bit of a dubious concept to begin with. but especially so when you try to apply it to Bitcoin, because Bitcoin clearly is a risky asset on a standalone basis, but in a portfolio and with very different return drivers, it can play that important diversifying role. So you see these episodes where you have the leveraged perpetual futures kind of create outsized volatility relative to, you know, what they really are as a percentage of the market. And that gives institutional investors pause. And they said, well, we kind of get the thesis, but we really need to understand, where do we think long-term correlation's headed, and is it actually going to behave the way we think it fundamentally should? And our view at BlackRock is, over the medium and long term, that it will, but certainly institutional investors are paying a lot of attention to some of that trading behavior.
So I think the thing is here that crypto's many things. Is it a digital gold, or let's say a monetary value that can't be debased? Well, absolutely. Bitcoin, XRP, these cryptos can be used as monies, fairer monies than what we traditionally get with fiat currencies. They are those things. Are they kind of like tech ecosystems where you can launch applications and financial systems on top? Yeah, they're that too. So that kind of is, we have to look at it in a different way. So it's quite complex, really, what crypto is. It's growing into be many things, but I think all are valuable ways to look at this asset class and try to value it out. Now, the other problem is it's very risky. It's very volatile, at least let's say. So the prices jump all around. These are shallow markets. These are volatile markets. And these are, for the most part, illiquid markets. So it's kind of like, as we grow and we mature, a lot of that will kind of go away. It'll fade away. But it's the reality of where we stand today. So is it a store of value? Is it a fair money? Yes. Is it a tech system? Yes. You have to kind of look at all of this stuff and try to put it together to come up with some kind of fair value. And it's very new, and institutions are trying to wrap their mind around this space here. Now, ARK Invest here, we see ARK Invest crypto exposure tops 2.15 billion as bullish holdings rise across 3 funds. So ARK Invest has increased its crypto-related holdings, with total exposure to the sector now exceeding $2 billion. So Cathie Wood, she's betting on a bullish future here for crypto. This week, ARK purchased an additional 105,000 shares of the crypto exchange Bullish, a CoinDesk parent company, for about $5.3 million. And remember this, Bullish was one of the launch partners for RLUSD with Ripple. Pretty interesting there. The firm's total stake in Bullish is now approximately 2.2 million shares. To increase its crypto allocation, ARK has been trimming positions in tech stocks like Palantir, Shopify, and the crypto-related asset allocation varies by fund. So anywhere from 29% down to 17.7%, but still making up a significant portion of Cathie Wood's overall investment portfolio. Again, these are the pillars of the future of finance, right there with AI. And you have the intersection of AI, blockchain, and they come together to really build the future of global finance here. Paul Berenstein, XRP, plot twist is what Brad Garlinghouse was working on all along here. Every major bank is trying to launch its own stablecoin. So people go, oh no, this is competitive versus what Ripple's doing. This is competitive versus what XRP Ledger, the utility it can provide. And this is what he's saying. We see JP Morgan, Bank of America, Citi, Wells Fargo, a consortium of stablecoins. Something has to make these interoperate with. And, you know, Citibank, they're not going to want to use Bank of America coin. JP Morgan's not going to want to use Wells Fargo's coin. So you have to have that settlement layer. Someone still has to solve that problem. Otherwise, it's kind of similar to what we have now, right? We have these different ledgers and we got to figure out how to settle between them. It's not that much difference, but going digital will help, the leaders in these spaces build out these systems. Ripple, like David Schwartz and other executives from Ripple have said before, they don't want to build all this stuff. It would be their, best scenario if a lot of that was already built. And then they could go boom with Ripple Pay right over top of it, XRP Ledger wired up, and they're ready to go. This is part of the building issue. But still, those stable coins on their own networks, they're walled gardens, maybe bigger ones, maybe more efficient ones, but walled gardens all the same. And settlement layers like XRP Ledger will still be needed for that future here. Just in, Solana versus Ripple. A Solana official account ignites a clash, claiming that Ripple is not on the same level. This is kind of childish to some extent. In a lot of ways, Solana is competitive versus Ethereum, right? They're both smart contract blockchains going for the same market. Ripple is kind of a Bitcoin with additional features. They're kind of competitive for certain markets there. And I would say Solana needs to worry more about Ethereum layer 2s. I think most of your main players, that they're not paid by Solana, if they're launching a type of system and they're considering Solana, they're probably going with an ETH layer 2. This would be, Sony, Swift themselves, JP Morgan, you name it. They might test Solana, they might use it, they might incorporate it. But Ethereum layer 2s, that's kind of where it's at right now in the field that Solana is playing in. You've seen Coinbase. They're making millions of dollars a month from their Ethereum layer 2. BlackRock is also building on that. So that's really what they should be worried about, not about XRP or Ripple. But again, we're closer market cap, so they're trying to claw their way up the market cap ranking, of course. Lastly, I'll leave you here with Bill Gates. And not one of my favorites, but I think he articulates a point I've been trying to make about a potential bubble here with an AI, because that's fueling everything. The AI spend is fueling the tech market, it's fueling crypto and all that. So how much longer do we have here? Are we going to hit a bubble with AI? Is AI everything we've heard? Let's play this to end the video here.
We need to define bubble. If what we mean is like tulips in the Netherlands, that they eventually looked back and said, what the heck, there was nothing there. Those were just tulips. No, that's not where we are. If you mean it's like the internet bubble, where in the end, something very profound happened. The world was very different. Some companies succeeded, but a lot of the companies were kind of Me Too, fell behind, burning capital companies. Absolutely. There are a ton of these investments that will be dead ends.
And you look at all of the investments that are being made today.
And we've seen this with crypto as well, right? Like, people pile into dumb stuff, it blows up, their investment goes to zero. The space goes through these bull and bear market cycles quite, quickly, really. They're not long, drawn out cycles. But AI is going to be the same thing. We're going to, like he says in this video, buy a bunch of chips, and then, oh no, here comes a new bunch of chips that replace it, and we didn't recoup all our money. This kind of stuff is going to happen, but if you're in tech, if you're going to be a technology company, you got to jump in here. If you're a financial company, you got to get into blockchain. You can't just sit back and let it all play out. So will there be bubbles? Well, yeah, there can be bubbles, even if a technology is very real. We've seen it with Bitcoin, we've seen it with Ethereum, we've seen it with XRP, right? You have these sell-offs, and it's very dramatic, and we will probably have that with an AI as well. But the end result is going to be a new future where, this technology changes life completely. Let me know what you think down below. As always, please like, please subscribe. The revolution will be televised right here on Jungle Link.
And you look at all of the investments that are being made today by some of the big tech companies, some companies who are not making money on AI yet, but are making massive commitments to chip makers and data centers, and say this math makes sense?
The AI is the biggest technical thing ever in my lifetime. I mean, it is so profound, and therefore its influence is hard to overstate. And the economic value, this is basically intelligence, where you can get medical advice, or you can get a tutor, or you can get somebody to help you design drugs. So the value is extremely high. Just like creating the internet ended up being, in net, very, very valuable. But you have a frenzy, and some of these companies will be glad they spent all this money. Some of them, they'll commit to data centers whose electricity is too expensive, right, that it could be done overseas, or they'll buy a generation of chips, and they won't have captured all their value before the next one comes along. But if you want to be a tech company, you don't get to say, no, let's check out of this race.
What do you think the public